Welcome back to the deep dive. You know, when most people look at financial statements, they just see this confusing mess of numbers, right? Rows and columns.
Yeah, just data.
But what if I told you those numbers are actually telling a story? Sometimes a pretty dramatic one, maybe even surprising. It's a story about a company's health, its strategy, maybe even where it's heading.
Mm-hmm.
The trick is knowing how to read between the lines, how to translate that story.
Exactly. And that's really our mission today, isn't it? We want to give you that shortcut, the key to understanding what the numbers really mean.
Right.
Forget drowning in calculations. We're pulling out the most important insights from this great guide on financial statement interpretation we've been looking at. The goal is to get you up to speed quickly, make you really informed. And honestly, there are some genuinely surprising things in here.
Yeah, definitely. So today's deep dive, it's all about moving way beyond just, plugging numbers into formulas. Anyone can do that.
Yeah.
But the real understanding, the kind that helps you in a meeting or just makes you feel like you actually get it, that comes from grasping the why behind the numbers.
That's the core of it.
So whether you're prepping for a big presentation, maybe trying to understand a new industry, or honestly, if you're just curious about how businesses work, this should really help. We want to arm you so you can see the real implications, turn that raw data into, actionable understanding.
Yeah, useful knowledge.
Okay, so let's jump in. The crux of this whole thing, financial interpretation is way more than just rote learning.
Absolutely.
The big problem, like we were saying, is that people can often calculate the ratios, no problem. But the real insight, the gold, comes from interpreting why things changed.
Right.
It's not enough to just say, oh, look, the gross profit margin went up. You've got to explain why it went up. What happened there?
That is spot on.
Mm-hmm.
And, the stakes are pretty high. It's not just about passing exams, though obviously it's vital for things like FR or SBR.
Sure, the qualifications.
Yeah. But more broadly, it's about developing real commercial awareness. That's useful in any business situation. It's like seeing a car speeding versus understanding why it's speeding. Is it racing? Is it just highway driving?
Good analogy.
You move from just seeing the data point to actually understanding the business reality behind it.
So if we're trying to be these financial detectives, what are the common traps? Where do people usually stumble when they try to interpret these statements?
Well, there are a few classic pitfalls. Sometimes, it's just not knowing the calculations well enough. That's basic.
Okay.
But a huge one is failing to connect the numbers back to the specific scenario, the background info you're given.
Right, the story context.
Exactly. It's like solving a mystery, but ignoring half the clues. Then there's sometimes a weak grasp of how accounting rules or issues affect the numbers, how choices impact the figures. And tied to that, often just a general lack of commercial awareness really shows.
So they might know the formula for a current ratio, but not get why it might be perfectly okay for, say, a software company to have a lower one than a factory, missing that real-world bit.
Precisely. And then very often, that discursive part, the bit where you actually explain the why and tell the story,
right.
Well, sometimes it's just not attempted. Or they struggle to reach a clear conclusion based on their analysis. You get the numbers, but not the verdict.
Okay, that leads us perfectly into the next bit, unpacking the scenario itself, because this is where it gets really interesting, like you said.
Yeah.
The golden rule seems to be you never analyze financial statements in a vacuum. That background information, the story details provided in the scenario, they are absolutely critical.
Couldn't agree more. A weak analysis almost always ignores the context. It's a massive missed opportunity for insight.
For instance?
Well, the scenario might tell you something about non-current assets. Maybe they revalued a building or bought some major new machinery or even sold off a whole division. You have to think about how that specific event impacts the numbers you're looking at. Otherwise, the picture you get is totally distorted.
Okay, let's make this concrete. Let's dive into some specific examples from the source material we looked at. How about a major asset disposal? Say a company sells off a big factory. What are the effects we need to watch out for?
Okay, selling a big asset like a factory. Yeah, that definitely sends ripples through the financials. First, you'll probably see a gain or loss on disposal hit the profit or loss statement. And of course, you get a chunk of cash coming in. But here's the really crucial bit. This is almost always a one-off thing. It doesn't happen every year.
Right, it's not part of normal operations.
Exactly. So when you compare results from this year to last year or try to predict next year, you have to remember, this won't repeat. Ratio-wise, the disposal makes asset turnover look better instantly because your asset base, the denominator in that ratio, gets smaller.
Ah, okay.
That in turn boosts your return on capital employed, your ROCE. And obviously, any profit or loss on the sale hits your operating profit margin.
So it can look like a sudden, maybe even amazing improvement. But without knowing about the disposal, you'd be completely misled about the underlying business performance.
Totally. It's like a sugar rush in the numbers. It's easy to get fooled by that headline figure.
Yeah.
Our source even suggests, and it's a good tip, sometimes recalculating key ratios like ROCE or operating margin without that one-off gain or loss, just to see the underlying trend.
Oh, interesting. Like adjust the numbers.
Yeah, or at the very least, you have to explicitly comment on how that disposal is distorting the comparison. And don't forget, liquidity, that cash injection, looks good, but you need to ask, what if? What if you were already deep into their overdraft? Maybe that cash just bailed them out of a really tight spot.
That's a great point, the what if. It adds another layer. Okay, what about something maybe less dramatic, but still potentially misleading, like just revaluing an asset upwards?
Revaluations. Yes, they can absolutely throw you off too.
Yeah.
If a company revalues its non-current assets, say, their office building is suddenly worth a lot more, on paper, their capital employed figure goes up.
Makes sense. The company's worth more on paper.
Right. But here's the weird part. This increase in capital employed actually makes both the asset turnover and the ROCE ratios look worse.
Worse, even though the asset is worth more.
Yes, because the denominator in both ratios, capital employed, has increased, but the numerator, revenue or profit, hasn't changed just because of the revaluation. There's no actual change in how well the business is operating or making money day to day.
Wow.
So the surprising insight there is that sometimes an accounting choice, not operational performance, is what's driving the ratio changes. You got to read the notes.
That's fascinating. It can make a perfectly fine company look less efficient just because of an accounting entry. What about buying a major new asset? Similar impact initially.
Similar initial impact on those ratios, yes. Buying, say, a big new machine increases capital employed. So again, it can make asset turnover and ROCE look like they've deteriorated. It might seem like the company suddenly got worse at generating sales or profit from its assets. But, and here's the detective work again, you need to check when they bought it. If the purchase happened late in the year.
The new asset hasn't had a chance to contribute much yet.
Exactly. It hasn't generated a full year's worth of revenue or profit. So what looks like inefficiency might just be a timing thing. Future periods could look much better once that asset is humming along.
That makes total sense. It really shows why you can't just glance at the numbers. It's like judging a sprinter mid-stride. What about management actions? Like if they deliberately do something to boost sales, how does that show up?
Yeah, the source gives a good example. Imagine management decides to offer big rebates to customers who place large orders. What happens?
Well, revenue probably goes up, right? More sales.
Revenue goes up, sure. But what about the profit on each sale?
The margin would likely go down because you're giving that rebate.
Precisely. You might boost the top line, revenue, but you sacrifice your gross profit margin. This shows how strategic decisions create trade-offs that you can actually see reflected in the ratios.
So you'd see revenue up, gross margin down, and then you'd hunt in the scenario details for the why. The rebate program, that's really powerful stuff.
It connects the strategy to the numbers.
Okay, let's shift gears slightly and decode the numbers themselves, the key ratios. Our source groups them nicely. Profitability, liquidity and efficiency, long-term stability or gearing, and investor ratios. Let's walk through some main ones, focusing less on just the formula and more on what they tell us, the implications.
Sounds good. Let's start with a big one for profitability. Return on capital employed, ROCE.
Right.
Formula-wise, it's profit before financing and income taxes divided by capital employed.
Yeah.
Capital employed is basically all the long-term money the business uses, equity and debt. And the profit figure is like the core operating profit before interest and tax.
So what's the significance? Why is it considered primary?
Because it's the ultimate test, really. It shows how effectively the business is generating profit from all the long-term funds invested in it. An increase. Generally, that's good news, an improvement.
Okay, but here's the key insight, right? Just knowing ROCE went up isn't the full story. You need to break it down. Look at its components.
Absolutely, because ROCE is essentially driven by two things: your profit margins and how efficiently you use your assets, asset turnover. So an improvement in ROCE could be because you're making more profit on each sale.
Got it, margins.
Or it could be because you're generating more sales from the same amount of assets.
More efficient asset use.
Right. Knowing which of those is driving the change gives you much deeper insight. Is the company better at pricing and cost control or better at sweating its assets? That leads nicely to the next one, asset turnover.
Formula.
Simple. Revenue divided by capital employed. It measures how efficiently you're using those net assets, that capital employed, to actually generate sales revenue.
And changes link back to
movements in revenue or the net assets themselves. Like we discussed, maybe revenue shot up or maybe they sold off assets. Both could improve the turnover ratio.
Got it. And the profit margins themselves, gross and operating.
Okay, gross profit margin first. That's your profit after deducting the direct costs of making the goods or services sold. It shows performance right at the trading level.
What affects it?
Things like changes in selling prices, sales volume, the cost of raw materials, or maybe having to write down inventory values. That all hits the gross margin.
An operating profit margin.
That takes gross profit and then deducts all the other operating expenses, admin, marketing, distribution costs, etc. So it tells you about the control of those indirect costs.
And the key is to compare them.
Yes, definitely link it back to the gross margin. If gross margin fell, you'd normally expect operating margin to fall too. But maybe it falls less severely. That could signal good control over overheads. Or it could be distorted by one of those one-off items we talked about, like a profit on selling an asset, which often gets included in operating profit.
Always watching for those one-offs. Okay, let's switch focus from making profit to paying the bills. Liquidity and efficiency. Current ratio seems like the classic starting point.
It is. Current assets divided by current liabilities. It's a snapshot. Can the company cover its short-term debts with its short-term assets?
And there's that ideal number people talk about.
Yeah, you often hear 1.5 to 2 to 1 bandied about as ideal, suggesting a comfortable cushion. But honestly, the really fascinating thing here is how much this varies by industry.
Right. You mentioned this service company example.
Exactly. A software company might have almost no inventory and lots of cash coming in quickly. Their current ratio could be below 1, and they might be perfectly healthy liquidity-wise. A manufacturer holding lots of stock will look very different.
So the insight is?
Compare to their past performance, compare to industry norms if you have them, and always check the scenario details. Don't rely on some generic ideal.
Makes sense. What about the quick ratio or acid test? Why quick?
Because it takes inventory out of the current assets before dividing by current liabilities. So it's current assets inventory, current liabilities.
Why remove inventory?
Because inventory isn't quick to turn into cash. You have to sell it first, maybe collect the cash. This ratio focuses only on the most liquid assets, cash, receivables, things you can access quickly.
Is there an ideal here too?
People often cite 1.1 as a benchmark, but again, massive industry variations apply. And for both these ratios, current and quick, you absolutely need to look for other clues, like is the company using an overdraft?
Why is that such a big deal?
An overdraft is a major red flag for liquidity. It means they're running out of ready cash. It's usually expensive financing, high interest rates, and it shows they might be struggling with day-to-day cash management. It's risky.
Got it. Okay, let's move to efficiency. How well are they managing things day to day? Receivables collection period, getting paid by customers.
Right. Formula is trade receivables divided by credit sales, or revenue, if that's all you have, times 365 days. It tells you, on average, how many days it takes to collect cash from customers after making a sale.
And shorter is generally better.
Generally, yes. Quicker cash collection means better cash flow. But here's a nuance. Sometimes longer credit is a deliberate strategy.
Like the sofa example.
Exactly. A furniture store might offer 90 days credit to attract customers for big-ticket items. So longer days aren't automatically bad if it's a planned competitive tactic.
So you look at the trend and the context. What does a shortening period suggest?
Shorter days might mean better credit control procedures, maybe they're chasing debts more effectively, or perhaps offering discounts for early payment.
And longer days.
Longer days could mean credit control is slipping, or maybe they're facing more issues with customers being unable to pay, potentially leading to bad debts.
Okay, flip side. Payables period. How long are they taking to pay suppliers?
That's trade payables divided by credit purchases, or cost of sales, often used as a proxy, times 365. It shows the average time taken to pay suppliers.
What does an increase mean? Taking longer to pay?
An increase could signal cash flow problems. The company might be stretching out payments, using suppliers as a kind of free short-term finance.
That's risky, right? Upsetting suppliers.
Very risky. You need to maintain good relationships. So while stretching payables might help cash in the short term, it can backfire. On the other hand, if the period is decreasing,
Paying faster.
paying faster might mean suppliers are tightening their credit terms, demanding quicker payment. Or the company might be taking advantage of early settlement discounts offered by suppliers, which is actually smart cash management.
Interesting trade-offs. Last efficiency one, inventory holding period. How long is stuff sitting on the shelves?
Formula: closing inventory divided by cost of sales times 365. It tells you how many days, on average, inventory is held before being sold.
And lower days are better here, generally.
Generally, yes. Holding inventory ties up cash. It's money sitting in a warehouse. Plus, there are risks: theft, damage, obsolescence, especially for tech or fashion goods. So faster turnover is usually good.
Good, there's a but.
But you need enough inventory to meet customer demand. Running too lean means you risk stockouts and losing sales. So it's a balancing act.
Definitely. Okay, final category, long-term financial stability, and the big one here is gearing. Feels important, especially for investors.
It's crucial. Gearing looks at the relationship between debt and equity financing. You can calculate it as debt divided by equity, or sometimes debt divided by debt plus equity.
And what does it indicate?
Fundamentally, it indicates the financial risk profile of the business based on its reliance on borrowing. More debt generally means more risk.
Why more risk?
Because debt has to be repaid and interest has to be paid, regardless of whether the company is making profits or not. It's a fixed commitment. High gearing can also make it harder and more expensive to borrow more money in the future.
But is high gearing always bad news?
Not necessarily, and that's a key insight. High gearing doesn't automatically spell disaster. Context matters hugely.
Such as?
Well, if the company has lots of valuable, tangible assets, like property, that provide good security for the loans, and if its profits cover the interest payments comfortably, what's called interest cover, then a higher level of gearing might be perfectly acceptable, even efficient. It's about managed risk, not just the level itself.
Right, it's not just the number, it's the story around the number again. Okay, so we've covered a ton of ratios and context. Let's pull it all together. What does this all mean? The ultimate goal isn't just calculation.
Not at all. The goal, the mission really, is to offer possible reasons for why the numbers changed, always grounding it in the specific scenario you've been given. And then critically, using all that analysis to arrive at an appropriate conclusion about the company's performance and position.
It's like building a case using all these financial clues we've uncovered.
Exactly right. And this is where the art part comes in. For the narrative, the interpretation, there isn't usually one single correct answer.
So what makes an analysis good?
What makes it stand out is the reasoned discussion. Laying out the possible explanations for the changes, linking them logically to the scenario, and then building towards a clear, well-supported conclusion. That's the difference maker.
It's about seeing how all these different pieces, profitability, liquidity, efficiency, gearing, the scenario details fit together to tell that company's full, nuanced financial story. Even the bits that aren't obvious at first glance.
Yes. Turning those potentially dry figures into a kind of GPS that can guide understanding and maybe even smart decisions.
Understanding the narrative, not just reciting the data points.
Couldn't have said it better myself.
Okay, so let's recap this deep dive. Interpreting financial statements, it really is this blend, isn't it? It's calculation, yes, but combined with critical thinking, understanding the context, and having that commercial awareness.
It's art and science.
It's about moving from the what the numbers are to the why they are that way, and then figuring out the so what are the implications.
Yeah.
Hopefully you listening now feel like you've got a much stronger framework to look beyond just the surface of the figures, to turn what might feel like overwhelming data into clear, useful insights.
You're not just looking at a spreadsheet anymore, you're reading the company's financial biography. Maybe even predicting the next chapter.
Exactly. So as you go off and maybe look at some financial statements yourself, here's a final thought to ponder. If you were advising a company whose statements you just analyzed, what single piece of non-financial information would you want most to truly understand their performance and why? Something to chew on until our next deep dive.